when I think about life insurance as you kind of age and get older in life, I like to think about life insurance in my mind and kind of the typical income replacement protection program. I like to think about it like a tipping scale. And here's what I mean. When you're young, you probably don't have the highest income you're going to have through the course of your life. You probably have young children. You probably have more meaningful debt than you do assets. And so the need for life insurance is really high at a young age. And what happens over time? Well, that scale starts to tip, right? So the need for life insurance is high, but as time goes on, what starts to happen? Well, you hopefully earn some more money. Your kids get a little bit older, maybe get closer to self-sustaining at some point in time. You're paying down debt like mortgages and you're accumulating investment assets. So all of those things start to lessen the need for life insurance. So hopefully we get to a point in our lives where we really don't need life insurance. That's why we're such believers in term insurance, because at some point it ends and we don't need it anymore. So why pay for life insurance that we probably, in most scenarios, wouldn't need as we get towards retirement? So that's just kind of philosophically how I think about really the income replacement or income protection as it relates to life insurance. Of course, we see it all the time. Clients come in, they've got a permanent policy or they have term expiring. And what we're really doing is we're just testing their financial plan and the assets that they have relative to the trajectory of their life and lifestyle to say, is there a gap? Is there a shortfall? We like to think this as a needs-based approach. It's not, hey, let's lead and sell life insurance. It's, do we need life insurance? If yes, what's the most effective way to fill that gap and for how long? And I think the thing that's interesting in term insurance is in term insurance, you can lower down your death benefit over time with the insurance company. So you don't have to keep paying the higher premiums. We can lower them down. You can do shorter terms than 30 years. And so I like to think of it that way. When we see the more permanent insurance in place, it's time to do a very thorough review and say, one, do we need this insurance death benefit any longer? Let's answer that question relative to the policy you have. And then second, if it's been a permanent policy, it probably carries cash value. And so answering question one of do we need life insurance and what kind of death benefit for how long would lead us into the next question of saying, well, what could we creatively do either with the policy to make it more effective, or can we do something more creative with that cash value to kind of upgrade the scenario? We are paying for life insurance with that cash value. Whether you understand that or not, right? The insurance company is still paying the mortality cost of a death benefit. So whether you see that or not, it's there. And so those are the things we like to draw out and kind of pay attention to then make a good decision of saying, is this still the right situation? Do we need life insurance or not? And how do we navigate through kind of unwinding a policy like that or moving it to something more efficient?